I've watched China for many, many years, and they are stuck in low gear in terms of what they need to do with getting their economy back. And this doesn't have to do, by the way, with trade wars and the concerns about trade wars. I think China would be seeing the after effects of, once again last year, going back to the stimulus trough, once again pouring more and more credit and over-relying on investments to generate growth instead of the things that they've said, several years ago that they needed to do.
Okay, let's get back to the United States, Patrick, because is it just me or maybe the myopia of the media and myself, which is that a couple of months ago, we were worried that interest rates were not rising enough, that inflation was going to go out of control. Now we seem to be worried that interest rates are rising too much and too fast, which maybe should lead us to believe there's some kind of weird Goldilocks happy medium happening here.
It is kind of funny when you hear people talk about, the market is scared of higher rates because, as you say, a couple months ago, the big concern was that the Fed was hiking rates and longer-term rates weren't responding, and you'd get an inverted yield curve. And an inverted yield curve usually means a recession coming. So the fact that rates are rising now, longer-term rates are rising, suggests to me, especially in the absence of a significant pickup in inflation, that there is greater confidence in growth. And if you look at stocks, two interesting things. The first is that despite all the good news, and there is plenty of good news in terms of economic momentum in the United States, the 12-month trailing PE ratio for the S&P 500 has come down almost 3 full multiples from a year ago, from 21.5 to 18.5. And the equity risk premium, which measures how much additional return you can expect to get over treasuries, that is at 5.4%. That's over 1 percentage point higher than the historical average. That indicates that actually there's room for equity valuations to absorb higher interest rates.
Okay, that was my question, because the bull can make the argument valuations have come down. The market is more reasonably priced. The bear, though, could easily make the argument, I guess I'll play one on TV, Patrick, that they are still relatively high historically in a rising interest rate environment with an economy that is probably as good as it's ever going to get. In other words, it may not have anywhere to go but down.
We are closer to the end of this cycle than in the beginning. I mean, people who talk about,
how close?
We're
how
at the
close?
Well, for the next 6 months, I think the numbers suggest that we're in the clear. After 6 months, there are a couple things that start to kick in. The first is that you don't have the one-time bumps from the corporate tax cut or from the surge in corporate buybacks that we saw this year. And so earnings growth comes back down to organic, which I would say is something more like around 5%. The second thing is that you have various events happening on the international front. 6 months from now, you have Brexit. So we might be talking about a different narrative about what's happening in the world.